Get ready for breaking news. Oil price volatility is sending shockwaves through the EV adoption landscape in India as the momentum for electric mobility surges forward. We dive into how this volatility is reshaping the entire electric vehicle push across the nation and what it means for your next drive.
Stop using your finger for notes, sketches, and edits. This Jam Jake stylus pen gives your iPad a smoother, more precise writing feel with palm rejection so your hand can rest naturally on the screen. It charges fast, works for hours, and comes with replacement tips. Perfect for school, work, or creative projects. Check the link in the comments to grab it on Amazon.
Next up, we look at the massive scale of the Saudi Arabia electric vehicle battery market. IMARC Group's latest research shows this sector is exploding, projected to grow by a staggering 24.72% from 2026 to 2034, reaching over $6,500 million. We'll explore how Vision 2030 is fueling this transformation, and which key players are dominating the race for battery production. Now, let's shift focus to Southeast Asia, where the energy transition is fiercely competitive. A new report from Traxon reveals that solar power and electric vehicles captured nearly 90% of the region's $1.8 billion energy transition funding. But wait, there's a big gap in the data. We'll uncover exactly where the capital is going and why crucial areas like energy storage are being overlooked. And finally, a major shakeup in the auto industry. Honda just set a precedent by selling a Chinese-made electric vehicle back to Japan. This strategic move signals a massive rebalancing in global automotive production, and we break down what this reverse import means for the future of car manufacturing worldwide. Stay with us for the full story. India's electric vehicle, EV, adoption is experiencing a significant surge, fueled by increasing volatility in global oil prices. According to recent reports from the Deccan Herald, the fluctuating cost of crude oil is acting as a powerful catalyst, accelerating the momentum behind the shift towards electric mobility across the Indian market. This economic pressure is making electric vehicles a more compelling and financially attractive alternative for consumers and businesses alike, driving a rapid expansion in the EV ecosystem. Saudi Arabia is rapidly positioning itself as a global powerhouse in the electric vehicle, EV battery sector, driven by ambitious national visions and massive public investment. According to IMARC Group research, the Saudi Arabian EV battery market was valued at USD 895.8 million in 2025 and is forecasted to surge to USD 6,540.3 million by 2034, reflecting a robust compound annual growth rate, CAGR, of 24.72% between 2026 and 2034. Vision 2030 is the central catalyst, with the Public Investment Fund committing over USD 50 billion to build an integrated EV ecosystem, prioritizing battery production. Key developments include the King Salman Automotive Cluster in King Abdullah Economic City, featuring Lucid Motors' facility capable of producing 155,000 vehicles annually, alongside Sear Motors launching domestic production. The kingdom's target of 500,000 annual EVs by 2030 is fueling upstream investments, particularly in lithium extraction from oil field brines, with Aramco and Ma'aden pioneering direct lithium extraction technology. Strategic alliances with entities like Pure Lithium and Theon are establishing local manufacturing capabilities for battery cells, battery management systems, and thermal components. Infrastructure is also expanding significantly through the EVIQ initiative, aiming to deploy 5,000 fast chargers nationwide, which will sustain demand and establish Saudi Arabia as a regional export hub for battery systems. Government policies are further accelerating this growth. Comprehensive incentive structures, including customs duty exemptions and reduced registration fees, are boosting consumer interest. The National Industrial Strategy mandates a 40% local content target for EV manufacturing, attracting Tier 1 suppliers to co-locate in special economic zones, offering 0% tax incentives. Investment commitments exceeding SAR 39 billion are specifically targeting battery metals plants and cell assembly facilities, exemplified by Obecan Investment Group, establishing a 3,160-ton lithium hydroxide refinery. Consumer behavior is shifting rapidly due to urban expansion and changing mobility preferences. Rapid growth in cities like Riyadh, Jeddah, and Dammam, coupled with increasing congestion, makes the operational benefits of EVs highly appealing. Surveys indicate that 35% of consumers are actively considering EVs, with mid-priced models capturing nearly 67% of the market share as disposable incomes rise. Technological innovation is also a critical driver. Researchers at King Abdullah University of Science and Technology have achieved breakthroughs in lithium metal batteries using nylon additives to enhance efficiency and lifespan. Furthermore, Thayon's lithium-sulfur technology promises to triple energy density while leveraging sulfur byproducts from local refineries, creating circular economy synergies. Local manufacturing is scaling up, with Sear securing SAR 5.5 billion in supply agreements, 80% of which are with Saudi firms, ahead of its vehicle launch. The kingdom's projected battery energy storage capacity is set to exceed 1.2 GW, demonstrating scalability through solutions like lithium iron phosphate systems and the deployment of BYD's cell-to-system technology across 5 Saudi sites. In summary, Saudi Arabia is executing a multifaceted strategy, combining massive sovereign investment, supportive regulatory frameworks, technological advancement, and evolving consumer demand to transform its industrial landscape and secure a leading position in the global EV battery supply chain. Southeast Asia's energy transition is heavily skewed towards solar power and electric vehicles, capturing nearly 90% of the region's $1.8 billion in energy transition funding, according to a recent report by Traxon. Solar alone secured $1.1 billion, representing 62% of the total, cementing its position as the primary driver of clean energy investment. Electric vehicles, EVs, followed with $505 million, reflecting growing interest in electrified mobility. However, the funding landscape reveals significant structural gaps. Critical enabling technologies, specifically energy storage and energy efficiency, remain severely underfunded, attracting only $119 million for storage and $77 million for efficiency, totaling just 11% of the investment. This imbalance suggests that capital is concentrated in established, policy-supported sectors, while system-enabling technologies are overlooked. The report attributes this safety-first investment approach to investor preference for lower-risk opportunities with clear revenue visibility, such as utility-scale solar and EV platforms. Yet, this concentration overlooks essential areas for long-term grid stability and decarbonization. Progression beyond early-stage funding is also limited across the ecosystem. Out of over 2,000 energy transition companies, only 13% have secured funding. Solar leads in maturity, with 109 funded companies, while EVs and storage lag. Energy efficiency has seen the lowest conversion rate to Series A funding at only 11%. A major structural mismatch exists between where capital is raised and where it is most needed. Singapore dominates funding across all subsectors, capturing 78% of solar capital and 94% of storage funding. However, major energy demand markets like Indonesia, Vietnam, Thailand, and the Philippines receive a disproportionately small share of this capital, limiting infrastructure deployment in regions with the greatest need. Globally, the disparity is stark, with U.S. solar funding vastly exceeding Southeast Asia's total. Within the region, progress has been tied to clear policy direction, such as Vietnam's feed-in tariff program. Investor activity further reinforces this trend, with venture capital firms showing a clear preference for solar and EV investments. Looking ahead, Traxon anticipates shifts starting in 2026. While EV funding is expected to recalibrate, energy storage may reach an inflection point, with early-stage companies in flow batteries and hydrogen potentially advancing to Series A funding, supported by development finance institutions. The report urges a pivot from asset-heavy generation towards a system-oriented approach, emphasizing investments in distributed energy solutions like microgrids, demand-side management, and grid software to ensure a sustainable and resilient energy transition. Unlocking the next phase requires shifting capital allocation to focus on the quality of the system rather than just deployment volume. Honda has set a significant precedent in the Japanese automotive market by launching a new all-electric model, reviving the classic Insight nameplate, which is developed from a vehicle built in China. Launched in Munich, the electric Insight is priced at 5.5 million yen, with the final consumer price estimated around 4.2 million yen after factoring in Japan's EV subsidy. Honda is initiating a limited rollout with an initial batch of just 3,000 units. The vehicle boasts a maximum range of 535 kilometers on a single charge, the longest among Honda's current electric offerings in Japan, and supports fast charging, capable of reaching 80% battery in approximately 40 minutes under ideal conditions. This move marks a pivotal shift, positioning Honda as the first Japanese automaker to sell a Chinese-built vehicle under its own brand domestically. This action reflects a fundamental realignment in the global automotive division of labor. Historically, Japan excelled in established manufacturing and hybrid technology, while China has rapidly matured its EV supply chain, offering significant cost and efficiency advantages in core electrification components. This reverse import strategy deviates from the traditional model where domestic factories supply the home market first. It signals a pragmatic rebalancing, leveraging China's cost-effective manufacturing capabilities to address Japan's current challenges in EV transition, where the domestic supply chain has yet to achieve necessary scale. Strategically, reviving the Insight serves to maintain brand recognition and signal continuity in Honda's electrification journey, offering a less risky path than launching an entirely new vehicle. The model is based on the NS2, an EV developed with Dongfeng Motor, which has undergone targeted localization, including adjustments to the right-hand drive configuration and charging systems to suit Japanese infrastructure. Honda's decision is also a response to market gaps. With its existing EV lineup dominated by smaller K cars and a lack of a mainstream passenger EV exceeding 300 km range, the company faces intensifying competition from rivals like Tesla and Toyota. Importing and localizing an existing platform is presented as a more efficient path to quickly replenish the product portfolio. Furthermore, this strategy alleviates pressure on Honda's operations in China, helping to boost plant utilization and spread fixed costs. The experiment suggests a broader trend. Geographic boundaries between production and sales are dissolving, with automakers increasingly relying on global resource allocation based on cost and efficiency, solidifying the role of China's manufacturing system in the global automotive landscape.